All right, well, good afternoon, everybody. Uh, this is Mark Robertson. Welcome to our Tuesday afternoon edition of Bull Sessions for May 18th, 2021. I'm joined here this afternoon by Matt Spielman in the back room and Len Douglas. Ken Kavula is on vacation and Kim is running amok or running errands or something like that. So thanks, you guys. How you guys doing today?
Fine as could be, Mark.
All right, so what I thought we would do today is just spend a few moments briefly going over highlights from the session, certainly entertain any questions or comments along the way. So the three of us will be watching for hands in the air or any entries in the questions box, but just thought we would go through and talk about a few of the things, along with some of the stuff I'm kicking around in the back office at Manifest right now as we get ready for a software upgrade and some pretty cool stuff here shortly. So let's go ahead and dig in. All right, here's your reminder. This is an educational demonstration. You guys all know this. I see a lot of familiar names, so welcome back. A few new names in the mix, so we have to be careful about this too. No investment recommendation whatsoever is intended or implied by what we do here today. At Manifest Investing and at the National Association of Investors, now known as Better Investing, we do pride ourselves on illustrating and demonstrating the lessons of the modern investment club movement. So we basically take 80 years of a track record and lessons learned and try to share that with individual investors, many individual investors who participate in things known as investment clubs. Some very successful investment clubs among us. You'll see some of the performance totals, at least for the Groundhog, here in a few minutes. Anything that we talk about here is our opinion. Please do your own homework. If we happen to own a share of something, we will attempt to remember to disclose that. Next Tuesday, we'll have our May Roundtable. It's a program that's been running for almost 11 years, or approximately 11 years. And it's a webcast where we basically come together, maybe share an educational nugget, but more importantly, take a look at a tracking portfolio and share 4 or 5 ideas and the analysis underlying those ideas, with the audience. And like I say, we've been doing it for over 11 years. If you'd like to check that out, we're going to show in a few minutes. You can actually access archived versions of that at YouTube, at the Manifest Investing channel. And if you'd like to be reminded about future events, like I said, the next one is coming next Tuesday night at 8:30 p.m. Eastern Time. You can come in your jammies with your favorite beverage, kick back, and just take it in. If you'd like to be reminded about that event and future events, send an email to nkavula1@comcast.net. If you have comments or suggestions following this session, or just follow-up questions, or you'd like a copy of the slides, keep in mind that all of this stuff is posted in the Manifest Investing forum, but send me a note at markr@manifestinvesting.com. All right, so let's go ahead and talk about a few things here today. The Bulls kicking back after the session last week. Successful Investing 3 was a series of 5 webcasts that went on from Wednesday through Friday. And I hope you guys had some fun. We certainly had some fun bringing it. I always learn something going through the program. And I thought we'd spend just a few minutes talking about that. Or if any of you have any follow-up questions, please feel free to do that. We are going to check in on the selections that were made at Friday afternoon's raucous, wonderful session of stock selections. And Matt was part of that, and along with 6 other people. We did run a little bit long, but I went back and listened to it, Matt. I thought it went pretty well. What were your thoughts on the whole session?
I was timing myself and I was aghast, but I know I wasn't the only violator. So I think it was all good. It was the stories, Ken's, bringing Google and having to apologize because it was so straightforward, I think kind of sets the tone. It's you do have to kind of look a little bit deeper into the corners in a market that's this high, but they were all great. I hated to compete against them. I guess I'll have to say I hate to compete against them for the next year.
Yeah, and it's not so much a competition as we really want to see how well the 16 selections do, yeah, there's an element of competitiveness, always is, but it really is a matter of just trying to lay 16 ideas out there that can get some traction and hopefully do somebody some good.
That's
So,
true. And to give you and Ken credit, I mean, you always present it as a team, right? It's the score, it's the total chart of the group together, and you always emphasize what the overall portfolio is doing, even as individual stocks go above or below expectations.
yeah, but I won't be bashful about pointing out if mine's in the number one slot, though, when that time comes. So,
It's a fact. I mean, when it's a fact, if it's a fact.
all right. So yeah, you ran a little bit long, Matt, but it was quality content. I have no complaints. I'm not aware of Ken receiving any complaints, even though it ran a little bit long, pushing up on 2 hours. But again, if you're using YouTube to go back and take a look at it, you can do that in 15-minute chunks if you want. And we'll talk about the companies that were actually covered during that session. I'm going to spend a minute just talking about the equity analysis worksheet that you see appear at Manifest Investing frequently using McDonald's. And I did want to share with the audience just some really quick lowest relative strength index screening results as part of this. We will cover other topics in future weeks. If there's something on your mind that's not on this list, let us know. Len, I did take a quick look at your Bitcoin primer. Looked pretty good to me. We will be talking about cryptocurrencies at some point. That is assuming that Elon Musk and Tesla don't completely crater the entire notion of cryptocurrency. They seem to be working on that here lately.
Yeah, I was impressed with the author when I got to the last page. He's the guy who started a website called Make Use Of, which I go to a lot for technical information, right out of college. And he started 2 companies since then.
No kidding. And what's the name of the site again, Len?
Make Use Of.
Makeuseof.com. Is that what it is?
Yep.
Make use
Yep.
of. And it covers a variety of subjects, obviously, including Bitcoin and investing, huh?
Well, Bitcoin is it's primarily what do I want to say? It's my go-to when I want some detailed information about Windows or Macs.
Okay. All right. Well, good stuff. We'll put a link to that in the session notes in the Manifest forum. All right. Our graph for the week is this one. Just a quick illustration. Those of you that have been with us the last couple of weeks, we have kicked around a little bit of upside downside ratio calculations, doing it just a slightly bit differently, but the concept and the general approach holds consistent. And the only thing we're doing different is we calculate all of them exactly the same way. We're using the 52-week low as our low price and the 5-year projected forecast as the high price, and forming basically an upside downside ratio and looking for companies in the buy zone or in the sell zone. And this just underscores in a fairly dramatic way, looking at the 1,700 companies in the Value Line book. By the way, by the time you take out some of the really weird companies and or the closed-end funds and asset management companies, you actually get down to about 1,500 companies. And over half of them are in the hold zone. You can see a bunch of them are in the sell right now. And a pretty thin slice in the buy. That just simply characterizes what most of you already know. It's not that easy these days to find a company in the buy zone. And that shows it pretty much in spades, I think. Okay. So let's go ahead and take a look at our groundhog results. Again, the only time we're going to show these is monthly, quarterly, or if there's a change in leadership. And we have one such change in leadership. A rhino has taken over the pole position. David Einhorn, he had actually dropped down into the teens recently, but something's going on at Greenlight, and they've actually assumed the lead. We still have the Maryland duo of Nancy and Ty up at the top, but a whole bunch of familiar names. Many of the usual suspects continue to persist at the top of the board, and there are a few names percolating up the ranks. I am back to 47th, so I might actually make it back on the list here someday. But that's with 140 something registrants, so some good clean fun. And we are having kind of tough days collectively. Our average total return is back down to 1%. A little bit of fence swinging going on there. And only a third of our entrants are beating the market. We typically see 60 or 70% of the participants actually beat the market. So it'll be interesting to see how that continues to percolate. And again, in a moment of good, clean fun, we respect her immensely. But if she were a groundhog, the chilliness of her fund, known as ARK Investing Innovation, ARKK as the ticker symbol, would rank 142nd out of 144. So that just shows you how sluggish the performance has been of late. Okay, any comments or questions on that, Len or Matt?
Not seeing any.
Okay, let's keep on pushing on then. Here's just a reminder of the conference that we had last week. Again, if you weren't able to attend, you can find all of the slides used in the Manifest Investing Forum, or you can send me a note if you'd like to have them. And there are links to the YouTube archived recordings. And I just want to thank Kim and Charlene and Cy and Pat and Matt and Hugh and Cy and Ken for an excellent series of presentations. It was a good show and greatly appreciated. I'm getting nothing but favorable comments back, Matt. So some good fun and good learning opportunities all around. Okay. For those of you that weren't there, and for those of you that were there, here's the quick summary of the selections that were made by the panelists, and pretty wide berth of styles and approaches and different types of companies. Cy has picked MKS Instruments, and so have I, for the roundtable tracking portfolio. Hugh McManus brought Gossamer Bio. Again, fairly early stage company, but he gave a great presentation, and I find it fascinating to see the wide spectrum of healthcare solutions that company is pursuing. And he has a pretty good track record of nailing down some of those type of companies. So Gossamer could be a good study for many of us in the audience. Again, we recognize that as a speculative opportunity. Not necessarily core, perhaps something for your watch list, but again, it's early stage, and they can be extremely rewarding, and they can also go to zero. And he makes that point during the presentation. Charlene brought Malibu Boats. That's one of Ken and my best small companies for this year. So the audience should be somewhat familiar with Malibu Boats, and especially those of us in Michigan that run around on the lakes are very familiar with Malibu Boats. Kim brought Palantir Technologies, pointing out that it's a company coming out of the incubator in California that's run by Peter Thiel. And it's an interesting company. I guess the one question that I have received from a number of people is Kim didn't exactly say what they do, and that there's a reason. It's kind of hard to figure out what they do. But I have heard them described as taking a slice of the CIA, the Central Intelligence Agency, and turning that into a research company kind of along the same lines of a Cognizant or an Accenture. So that's basically what Palantir does. They focus on big data and this artificial intelligence and this extended learning concept that's out there. So that's what they are. Again, slice of the CIA and basically turning that into a publicly available company. So that might be the way you want to think about that one.
Yeah, and that's a very similar line. Again, not to tout it, I'm looking at it myself, but Marie Frank's idea of, and this is another SPAC, DFNS, but they're buying IronNet. And in a similar vein, they describe themselves as operating to what the NSA does. But inside the NSA is explicitly not allowed to operate within the bounds of the U.S. So what intelligence they could get, sort of probing the network, they can't do. But IronNet takes volunteers, if you will, that say, please come secure our network, and uses a lot of the same techniques, and in fact employs a lot of people who used to work for the NSA, so they know those techniques to use it. And Palantir's the same way. You get people out of that service with skills they know what to do, but just to a different problem, not national security, but business problems.
Yeah, it's something that I can definitely relate to. I spent a couple of years with Booz Allen and spent some time in McLean, Virginia, right there next to some of the government think tanks. And I saw people, working in those type of capacities that came out and did some fascinating commercial stuff. So it can be a real wealth of opportunity. Matt, would you like to take a moment and just hit the highlights on Green Brick Partners?
Oh my goodness, another 60 minutes. Hey, Green Brick Partners, guess what?
Hey, we don't have a hard stop here today, so just go for it, man.
Stretch for time.
We get your
Number one
slides
holder of Green Brick Partners, the aforementioned David Einhorn. Enough said. Won't say that's fully to take credit for his performance, but certainly it dragged him down, because Green Brick was as high as 28 and now is 23 and change or so.
Okay.
Fast growing. An aspect I cut that wasn't even the extended cut. What I did, an aspect that I cut is the idea that all builders are growing. Green Brick as a small grower focused on that inorganic growth, on acquiring other companies. It's very similar to what we see so much success with, like Five Below or Fastenal or so many other businesses in what would otherwise be a low margin business, which home building is not necessarily, but as they spread across the country, as they build a nationwide network and see both the leverage of size and as they find opportunities operating in new areas, that just accelerates their growth. And that's the Green Brick only operates in 4 markets. They're about to go to their 5th, as we talked about Friday, is Denver, which is just up the road from Colorado Springs, but an entirely different market, much bigger. I think that's really the accelerant, is that they are moving places and have high opportunity places to move still, as opposed to moving just with the market, sort of the rising tide lifts all boats thesis.
And now they've got a substantial presence in Texas, right?
In Dallas specifically. They actually aren't. They are not in Houston. They are not in San Antonio or Austin. They are all over Dallas.
So they've got a real healthy. I imagine there's no lacking things to do in the Dallas market right now.
Yeah, for sure.
So yeah, they've got a pretty good inventory and backlog to launch from. And like you said in the presentation, Denver appears to be a pretty good opportunity also.
Yeah. A lot of people moving east to Denver, which is kind of counter to the historical viewpoint.
Mm-hmm. All right, Pat Donnelly, who actually had the top selections in the year ago panel and the November panel, and Pat came with Algonquin Power. That can probably best be characterized as a fairly traditional utility, a regulated utility that has a pretty strong emphasis on renewable and that type of stuff, from wind turbines to solar to a number of things, including some fairly innovative water utility approaches, but fairly wide ranging and kind of a fascinating electric utility / hybrid regulated utility, and pretty good look. I brought iRobot, one of the more tame presentations of the afternoon. I mean, iRobot is exactly what many of you own one of these little hockey puck style discs that runs around and vacuums your house. That is predominantly what they do, and they're having a pretty good run with it. And I basically walked through and showed them to be a well-managed company with really interesting upselling. And one thing that I probably forgot to mention in the presentation is these guys are basically trying to become the Netflix of vacuum cleaners. They're putting together a subscription service. And what you literally have is this turnover and upselling and continuous process of, you basically you throw your old vacuum cleaner in the box and they send you the next model, and this constant changeover type maintain and optimize process. So it's really an interesting model. And then what was fascinating, as Matt has already mentioned, is Ken got down to Alphabet and Google and had to almost apologize for how ordinary it was. it was really kind of funny to hear. He's looking at up, straight, and parallel, and significant growth rates, and extremely high profitability, and decent PE ratios, and he was almost having to apologize for it as he did present it. It would be interesting to take his Google presentation and then go back to almost a year ago when we talked about life after Google and,
Yeah.
and the
Well,
assault on the business
that's
model.
irony.
Yeah, and a little bit ironic, and see, Ken, what do you think? Now, obviously, we're only talking about the next year or 4 or 5 years with the selection made here, but still long term, there are some pretty smart people that question the Google business model going forward.
Yeah, Yahoo's still hanging around. I think Google won't go away in 5 years.
Yeah, good point.
There's a comment, Mark. Dennis Roman brings up that the Better Investing Weekly email, which hasn't hit my inbox yet, includes a filter that has a number of these companies on it. He said, including Vertex and iRobot, as a screen with earnings per share greater than 15%, PE below historical average, and projected return greater than 15%. So we have some confirmation already. So we can thanks the folks at the home office for that.
Okay, good. All right, and then in the lightning round, you can see the selections made by the 8 panelists there. Some of them fairly robust and a little bit less conventional. Vertex is a company that's been around for quite a while. They do some fairly amazing things. My family made a lot of money on Vertex a few years ago. I wish we'd have hung on because we would have made a ginormous amount more. Just an example of early stage investing in biotech and pharma. ASML has to do with semiconductors. Charlene went for the comfortable shoes. Interesting play with Skechers. Ardelyx is no stranger to many of the people in the audience. Ardelyx is basically a phase 3 company for the development of a solution for irritable bowel syndrome. And along the way, they've discovered that one of the medications that they are working on actually has tremendous benefits for dialysis patients. That if you're on the program for dialysis, many times you have trouble with phosphorus levels in your blood, and they have come up with a medication which tends to help that quite a bit. So they're in the middle of testing of all that. They came out recently with a FDA ruling that they needed to be more specific on their labeling or whatever, and it ended up in a delay on their phase 3 results for, let's say, 30 or 60 days. And the stock price went from 9.5 back to about 6. It's since recovered back to about 7. But keep in mind, this is a company that was featured in the roundtable approximately 2 years ago at $2 a share. And it has gone from $2 a share to $9 or $10 a share, and has a 1-year price target, still does, of $13 or $14. So kind of an interesting play, and Kim just doubling down on the reminder. Now, Matt, this is we were talking before we got started here at the session in the green room about Sophie and the SPAC. Why don't you give us another 35,000 foot description of what's going on here?
Sure. So SoFi is social finance, which started in 2011 as a peer-to-peer student loan company out of the proverbial dorm room and literal dorm room, but is now I won't call it a lending giant. It's nowhere near the size of Quicken Loans, but not only does student loan financing, but as well as mortgage financing. So it's one of those non-bank mortgage lenders. Since they're not a bank, what they generally do is package up those loans into securities, then sell those securities and make money by servicing the loans and then turning around and re-lending out the money. The reason why they are in the SPAC market to raise some cash is that they're busy becoming a full-fledged bank. In fact, as part of their plan, they had planned to actually found a bank, which is a lengthy process. They took a shortcut. They bought a one outlet bank on the West Coast, and you'll find that every online bank, Ally Banks, one physical branches in Pennsylvania. State Farm Banks is in Illinois. Every online bank actually needs to have by regulation one physical outlet, so they generally do. But they are growing those and investing a lot in the app, in the technology, as well as the marketing to cross-sell into their established lending business, which of course is sticky, right? When you take out a student loan or a mortgage loan, you're dealing with that company for years and years, and as long as that company doesn't screw up, doesn't make it a bad experience for you, then you've got loyal customers. So they're in the race for online banking with an established and profitable business lines. Overall, the company will be break even this year as they make all these investments. But the other thing they have is they actually bought it in 2018 is a platform called Galileo, which to if you squint, you can say it's Amazon Web Services for fintech. So they not only have a service, they also provide service to other customers, and those customers include, for example, Robinhood, and what a lot of people in Europe would recognize as a cross-currency bank called Revolut, which is very gets a lot of use in Eastern Europe. So they are running the plumbing for a lot of winners as a hedge or as a way to drive the industry in addition to their own bet. We do have a hand in the air, Mark.
Okay. Want to check and see if, yeah, I see Judy.
Sure.
Judy's.
Yeah.
See what's on Judy's mind, if that's what she intends.
Yeah, you're self-muted, Judy, if you want to talk, or is that an inadvertent hand? Judy Herbolsheimer? No.
It's a relatively new name, so it might be inadvertent. So, Judy,
all right, we'll take it down.
Figure that out. If you have something on your mind, put your hand back up, and we'll figure out how to get your microphone open. All right, in the final three selections, Pat Donnelly came with Ollie's Bargain Outlet. That's a stock which has been featured at the roundtable and has been appearing in more and more investment club portfolios. And I've not shopped at one, but I hear good things about it, and good
it's
stuff
an experience. All around. Take your flea marketing skills with you.
Okay. Excellent, because I don't like to shop, so not good stuff. Now, on the next entry, let's do Ken's, and then I'll come back to mine. Ken's is a Canadian, basically infrastructure engineering type systems company, and looks pretty good, up straight and parallel. And the only thing, his only complaint is it's a little tough to track down information on it, so he invited anybody who knows anything about the company to drop him a note, but it does look fairly interesting. And now my pick was Emergent Biosolutions, worst performing stock from a year ago in this contest. And I can hear Len saying, no, Mark, say it ain't so, because Len sends me all these articles about the factory or the manufacturing site that got him into all the trouble with the COVID vaccines and Johnson & Johnson. And I'm just going with the gut instinct that it is just 1 out of 9 locations. They have a whole bunch of other stuff that's not COVID-related business. And there is a pretty good company in there. And I just think that some of the press that's been received on Emergent has been a little bit sensationalized. Obviously, they struck a nerve being a company that behaved badly in a very high visibility, vulnerable position. So I have no way of knowing how long it's going to take that company to return back to normal. The CEO did mention that they have not lost a single existing customer, at least not yet. And just some interesting stuff. The other thing that came to light, and I talked to Hugh McManus about this because he was actually in his day job. That's his line of business, and he pointed out that the actual wording behind what they received from the FDA wasn't even a warning. It really was kind of a, hey, you need to clean up a little bit here type severity. And again, we point out that they basically had a bad batch and they caught it. None of that got out. Whatever went wrong there, they caught it and they're correcting it. So again, probably not the end of the world. And that I included that as part of my presentation. But again, there's no way to know the timing on something like this. And we tend to be a forgiving nation. We'll see. We'll see.
Well, I think they're helped too. It's not like their logo is on your next loaf of bread or something. Their customers not only need them as we're manufacturing vaccines in such doses, but they should be rational customers. They're not looking. It's not like Apple suddenly developed an internal virus or was found to sell your information to unsavory people or something, and everybody just left them yesterday. It's a needed function, and its customers don't have a lot of I don't know, say emotion in the decision.
Yep.
We do have a question kind of along this way, Mark, and I think it's a good one. Just in the way that you've talked about the company and what do we decide about a company that's had some spat of trouble. So this is Nikki, and I apologize, Nikki. It's Nikki Petrika asks, what are we to make up for all the lawsuit alerts popping up around EBS now?
Oh yeah, yeah. Because of the high visibility and obviously this strikes a nerve with everybody in the country. The incident that happened. There are literally, I think, hundreds of law firms going after this company, in the class action stuff and whatever. I will tell you my general approach to this is a lot of times I'll go to the Wall Street Journal, and you can actually search for news on companies, and then there's actually a checkbox on the Wall Street Journal online edition that allows you that basically says just show me the important ones, and you flick that box, and all of these class action suits go away. They actually disappear from the screen. And there's a message in that. And the message, at least from my perspective, I could be wrong. It's just an opinion. There is perception damage. All that stuff is real. But by the same token, in order for these to be a real problem, they have to have done something, I'm using air quotes now, criminal or blatantly negligent. And there has to be some form of harm that can be, it's got to be significant harm. It can't just be risk of loss of your investment dollars, because that's likely, we're looking at that obviously with the drop in the stock price. But in terms of actually doing something nefarious or intentionally wrong or illegal, then you would have something to worry about with all of those lawsuits. Mark's opinion, I'm not an attorney. I don't play one on TV, but my experience in dealing with these, the question we often get was, you pull up a company like Lilly or Merck, and somebody will say, well, they've got lawsuits. And my answer to that is, around here we call that Tuesday.
Yeah, exactly. That's my feeling too. Is I couldn't tell you the number of companies that I have owned, and either while I own them or shortly after I've owned them have had any number of lawsuits coming on. Any event that is a divestiture, is a miss of earnings, attracts this industry which works on contingency, and not that that's a bad thing. That there's use for people who otherwise wouldn't get representation there, but it seems to be sort of just part of being in the market. The people have opportunity. People respond to that because they do lose money in the market, and that's an outlet for them to try and react to that.
But the other thing that I just ask everybody to think about, again, from 35,000 feet, is You see all these class action suits, and they reach out to you as a shareholder, and basically say you get involved in this, and you may actually receive $1 or $2 or whatever the number is. Who do you think's paying for that? The legal fees and the stuff that goes on in association with an event like that. If you're a shareholder in the company, you're paying for it anyhow. So it's
Right.
just.
Do you want to lose 50 cents or $1 of it?
I mean, I have watched companies literally disappear from the planet, while they're paying off all the lawyers on both sides. So whatever. All right, here's a quick look at attempting to characterize the companies which were presented. Two of them have limited information available. That'll change ultimately. But what you're looking at here is from top to bottom, the RSIs actually run to the lower end. We like to see that. There's some 30s in there. There's certainly no 70s or 80s. So these are companies that in many cases have been beat up. By the way, where is Emergent Biosolutions on the list? There you can see down at the bottom, their relative strength index is down around 37. So yeah, the stock price is beat up a little bit. You see there. Growth rate from the stock studies on the company, the quality ranking. The only one that is really non-car is Ardelyx, very early stage. That's the irritable bowel syndrome and dialysis company. You can see the PARs from top to bottom. Again, it's what they add up to that matters the most. We see 14 or 15% from top to bottom, a growth rate in the mid to high teens. The projected return on value, something that we have been focusing a lot of attention on at Manifest Investing, and I see some very nice numbers there. A couple of them are a little bit low, a couple of them are a little bit high, but that will ultimately be resolved. And you can see, as Matt was saying when we first came online, that earlier today, he was up 3.6% this morning or yesterday, and apparently has tacked on, another 8 or 9% today, Matt?
Just about 7, fading a little bit, but you don't want to leave everyone in the dust so fast.
It's
Sandbag a little bit.
It's early. And notice that Emergent Biosolutions has assumed that comfortable position at the bottom, sort of like the horse at the Kentucky Derby that comes out of the gate last.
Rope-a-dope.
Rope-a-dope. All right. Here's a quick look at the analysis of McDonald's. Just thought we'd spend just a moment talking a little bit about some of what goes on in the analysis of companies. You can see that the visual analysis is on the right-hand side, and we'll just kind of step through this a little bit. I want to bring your attention to some of the new stuff that we've been playing with just a tiny bit here as we go. But again, what we do with any company, and we believe that the two most important characteristics of any company, any investment that you study, are two things. Is it a good company? We want excellent companies, and we basically focus in on the quality at Manifest Investing, and that is in the top 4% of all companies. So they rank, McDonald's ranks very high. That doesn't come as a surprise to any of us. And then also the return forecast that you expect from the company. So based on the assumptions which are here, and we'll go back and cover them in a second, we're basically looking at a company which has a projected annual return of approximately 6%. It says 5.9 there. So the company McDonald's checks in at about 6%. The average stock amongst the 2,500 companies that we follow at Manifest Investing does check in at about 6% right now. So it has an average return expectation. How do we get to that? Well, basically, we take a look at the historical data array. Let's focus in on the sales up here. This is a company that has been kind of morphing and changing over the years. It's certainly not an exciting growth story. If you left those in the regression, you'd actually have a 0 growth rate. That comes as no surprise. McDonald's is not an exciting growth story anymore. There are McDonald's everywhere you look. But they have been kind of morphing through the menu and some of the things that they're doing internationally, and some of the menu selections, etc. Picking up breakfast a few years ago is an example of a change to the business model which made an impact. But if you focus in on, what does this company look like going forward, closing a few of the less profitable outlets, opening hopefully higher profitability outlets, fairly interesting trend that checks in at about 4% for this the slope of this red line. So about a 4% growth rate going forward. Value line, I believe, checks in at 5 or 6%, so they're a little bit more ambitious or optimistic. But we basically see a company that we all know well that is projected to grow at a rate like that. One of the things that you see happening with McDonald's is they had, even though they were kind of made to order, no pun intended, for what we've gone through with COVID, this entire period here was kind of rough on the restaurants, even though they've had the drive-through in place and damage was minimized. Much of their damage, as I perceive it, has been internationally, where they basically had more shutdowns and abandonments of opportunity internationally. But what you see happening is, it is kind of recovering back. They actually project to be back on trend by the end of calendar 2021. But right now, if you actually looked at the trailing 12 months for McDonald's, it's going to be somewhere in that perhaps south of 20 billion range. And we basically use the dot on the red line, following basically on the red trend line, to establish this number. So instead of using 19 or 20 billion, we're actually at 22 and change. That's just simply to match up with the trend and match up with the long-term forecast. And it's for a company that has been disrupted by the economy and what's been going on. So roughly 10 or maybe 15% of the companies out there have been really disrupted by the events of the last year or so. So we do see a $28 billion company in a few years operating at approximately 30% net margins. You can see that makes a whole lot of sense based on this picture down here. So 30% net margins. And the last assumption is a PE ratio in basically 20, give or take. And that certainly lines up fairly well with this visual look down here. So again, we're looking at a company growing at 4% with 30% profit margins. By the way, I wrote a long paper 15, almost 20 years ago now on McDonald's saying that their 20% profit margins were going to 10. So wow, I was off on that one. My whole theory was that their burgers were shrinking and getting thinner and the buns were getting smaller, and all, I had my reasons, but I was delusional. This company is basically...
And they added coffee.
Yeah. $3 coffee when it costs them a fraction of that to make it. Yeah, good stuff. So that gives you some idea where the projected annual return comes from. We throw in the dividend yield, and it gets you to that 6% number. So that's kind of some of the stuff that's going on behind the scenes. You can see the ones that look like they don't belong here. We don't talk a lot about outliers at Manifest. Ken really shrugs off most outliers, but there is a point on this graph and on this graph down here that just doesn't fit with all the others. And that's one of the reasons that we look at the trend instead of the trailing 12 months for the projection of that future sales number. All right.
Yeah, I think too, Mark, it's particularly an issue when that outlier is the last data point, right? When you go onto Yahoo and you're going to see a PE of 35 and you think, well, I'll skip it, or even if you just screen, and a lot of people I know that have been investing for a long time get uncomfortable with any PE over 30. Well, guess what? 80% of PEs are going to be over 30 because they're looking at last year's earnings.
Right.
And it'll be a really interesting. I think it's going to test a lot of the tools or the way people discover companies, that anything looking at the last 12 months is suspect. You have to look at a longer trend, or you'll be panicked out of taking any action, or panicked into selling.
I think it's another symptom of what's a weakness with Wall Street and the rhinos, is that they do an awful lot of quarterly stuff and year over year stuff. And when you start comparing back a year, there's been a whole lot of mayhem and chaos in the last year or so. I mean, look at right here, this price bar. I mean, it's a little tough to make out, but look at how big it is compared to the rest of them on the chart. It just tells you something weird's going on there. So It's a great point, Matt. Ken and I did a presentation a year ago, basically 13 months ago, where we talked about across the chasm, CHASM, chasm. And we pointed out that we thought we were in the middle of, and we didn't know, kind of what Matt was just talking about, the numbers were starting to get really weird. And there was clearly an economic mess in progress. And we talked about, here's your chasm for McDonald's right here, in the revenue chart. You need to keep your attention not on that year so much as, what does the rest of this look like? What's it look like on the historical side of the chasm? What's it look like over here? And, what was the probability that we were going to return to that red line? And so across the chasm, you can go back and find the presentation. I'll include it in the show notes. It's just a reminder. For me, it enforces and validates and underscores how powerful our method of analysis is, because we're paying attention to those 4 points. We're not worrying about next quarter. We're basically worried about that red line, and it really is conducive to keeping your sanity when we're in that period like we were 12 months ago, 9 months ago, 6 months ago, and some of the weird numbers that we're seeing. All right. One of the things I wanted to point out here was projected return on value. That calculation is right here. All of the inputs for it are here. And you've heard us talk about this. We will actually provide a session sometime soon again, just reinforcing some of the stuff we've been talking about. We believe that this projected return on value, in a relative way, can serve as a checkpoint or a sounding board for the projected annual return. Because the only difference between the numbers and the analysis that we do is that the projected return on value doesn't involve PE ratios. So if these two numbers are dramatically different in an analysis that we do, we instantly look back up the page and say, well, am I using the wrong PE? So it becomes a very important and influential, I'll call it a third opinion. A third opinion that, maybe your PE ratio is out of whack in the study that you're doing. And I would just encourage the audience to be aware that we are comparing that projected return on value versus the projected annual return, knowing that that is the PE ratio that can mess up the comparison between the two the most often. So it's kind of a neat thing to sink your teeth into and come to understand the calculation. All of that stuff is pretty straightforward. The projected return on value is literally the projected pre-tax income, basically taking the 5-year earnings forecast and adjusting it for the tax rate. That gives you basically the 5-year pre-tax income, and dividing that by the enterprise value. The enterprise value is the stock price or the market cap plus the total liabilities minus the cash on hand. That's in the denominator. It's known as the enterprise value. And the really cool thing is all of the debt, all of the current credit card balances that a business might have, they're in that total liabilities number. So when we're talking about an enterprise value, again, the formula is the stock price or the market cap plus the total liabilities minus the cash on hand. And you can get some very interesting numbers. Very, very guiding. We do take a look at the long-term debt and the annual interest payments for purposes of figuring out the effective interest rate. That is a big component of financial strength at Manifest and the quality rating. It's basically the answer to the question. I don't know about you, Matt, but for years, I look at the rating agencies and I see, BB plus and DD minus and all these letter grades and pluses and minuses. And, I understand what they're doing. I just think it's alphabet soup to me. I want to know the answer to the question. If McDonald's walks across the street and wants to borrow money from a bank, what will they charge them for the interest rate? And the interest rate for McDonald's is less than 4% on $34 billion worth of debt. So that basically tells me all that I need to know about the financial strength of McDonald's. I mean, if they went out and borrowed $5 billion tomorrow afternoon, they would probably be paying an interest rate of approximately 4%. That's how strong they are regarded. So I don't care what the letter grades are. I care about, what will actually happen to the business model for McDonald's or any company that you happen to be studying. So this effective interest rate is an important number in understanding the debt characteristic of any company. All right.
Yeah, I think the letter grades took a hit in their reputation with the 2008 financial crisis, and I think interest rates are so low. Every borrower is able to borrow at such a low rate. It's kind of nitpicking. If there is any difference between A and triple B and C, it's so small to be nearly irrelevant at the moment. In the long run, and the other thing really impressive, Mark, is not only, and I'm sure a lot of this debt for McDonald's is long term. It's not only that companies are able to borrow low, but you see companies borrowing essentially in mortgage time frames, 20 years, 30 years, even longer, and so that is a significant asset. If inflation or if high interest rates ever come back, they will certainly not look to redeem those bonds. That will be the cheapest money they'll ever get.
Yep, good stuff. So there's other things here as you want to look through some of the companies. We were out with Starbucks and a couple others here recently. Here's the upside downside calculation. Again, I want to look at a number of companies in light of some of size concerns about how the upside downside ratio behaves in different markets. I understand that the dividend yield is not in there. There are limitations, but at the same time, there actually is some fairly interesting stuff percolating out of it. I do think these numbers are at least worth noting, the ratio itself and the buy below and sell aboves. So again, we'll spend more time with that. Again, searching for any vulnerabilities or any weaknesses and emphasizing strengths also. Down here at the bottom is just simply to look at the low total return forecast. We'd like to do that because that's the one that comes true most often. So we see a number here of 3 for McDonald's and that sort of thing. All right, one of the things that I did want to point out is I did spend some time thinking and really wrestling with this one because this goes all the way back to over 20 years ago. And one of the first articles I wrote for Better Investing about quantifying the quality of a company. And we went through and developed basically this four-legged stool process based on the teachings of Benjamin Graham and George Nicholson. And it's been the basis at Manifest Investing for the quality ranking forever. And that's basically taking an equally weighted look at the financial strength, the EPS stability, and then the relative growth and relative profitability of all companies. I am actually wrestling with the notion of abandoning the calculation itself as you have traditionally known it, which is on display here, which is confusing to many. Some of the traditionalists in the room are actually probably almost losing consciousness now because you hate change. But I will tell you that a person off the street that struggles with this concept, I think they get the concept of those 4 pieces are important, probably equally important, especially if you read Graham or Nicholson's work on the subject. But the calculation itself that actually was in that Better Investing article 20 years ago can tend to be a little bit confusing. With Manifest Investing and the database that we have the ability to rank them from 0 to 100. And that's what I'm showing you here for McDonald's. And I'm not so sure that a person off the street doesn't get that quicker than most of us who have been indoctrinated and been looking at this calculation for years. But when I think about McDonald's, first of all, you saw that less than 4% loan rate, interest rate. Their financial strength is good. And when it's ranked using, Morningstar and Value Line and that effective interest rate and other measures of financial strength, when you basically put those all together, glom them all together, and then rank them, McDonald's ranks in the top, 6% of all companies. Their earnings per share stability, I mean, look at here. That's a pretty straight situation. And the thing that we do differently than other agencies is we actually include the forward-looking estimates in that calculation. So McDonald's checks out pretty good there also. What McDonald's has as a weakness is their relative growth. Again, if you put these numbers back in the trend, you're talking about a zero growth company. So it's a low single digits growth, and how that compares to the universe of companies out there, they're in the lower third. And there's nothing wrong with that. They're mature. They are at that stage where they pay more in dividend, and the trade-off between growth and dividends is there, and it's intact, and it's solid. But the relative growth actually dings them just a tiny bit from an investability standpoint. And profitability, that 30% number we were just chatting about, this 30%, it stacks up extremely favorably versus restaurants and their peers and competitors, and then versus the universe of all companies. So literally, these four factors, as shown up here or added here, add up to this extremely high quality rating. So again, just kind of playing with the notion of throwing out the top half of that page and replacing it with what you see there. And I haven't decided, just thinking out loud here, but I really like how clean it becomes and how easy it is to understand for the average person. Any thoughts or comments?
So it's interesting, Mark. I wonder. This is the IT in me. It's going to come out. I wonder if you simply, since you're not talking about adding existing functionality, you're talking about pruning the tree, if you will. If you can clear the clouds, I wonder if you simply hit it or made it part of an advanced view or an old view and see how many people actually activate it. It would give you maybe an indicator how many people use it, one versus the other.
Yeah, and we could possibly build in some type of a toggle. Again, appealing to your IT characteristic. If you go to a place like Morningstar or Y-Charts or any place, a lot of times they'll have that classic versus new toggle.
Yeah, exactly.
Yeah, so that might be something that we tinker with, and give the user the option of, you can look at it either way.
Mm-hmm. And then you can, you as the system owner, can follow along, and in essence, everyone's voting by what they're using, by what they're seeing.
Yep. Okay, just thought we would share again longer term outlook on McDonald's. I don't know how you can look at that and not say that this is weird. In terms of an outlier, yeah, that's some pretty weird behavior. So there was quite an opportunity there, and you see the chronicle for McDonald's kind of bearing that out also, with the highest projected return in the last 4 years in the middle of that chasm. All right, quick screening results. We are running up against an hour, so I'll try to wrap things up here. One thing that we do like to share here from time to time, you never know if an opportunity will erupt when you search for the lowest relative strength index companies. I love an RSI below 30. I love it even more when it's below 20. And when it gets down around 10, I'm probably going to be looking at those very, very carefully as an investable opportunity, either in my special situations non-core account or assuming ownership for the long term. And you see here a pretty good list of companies that are down in that less than, in this case, 25 range. Nothing really jumps off the page in any great detail other than that A2 milk company out of New Zealand and Australia that I have been accumulating, being stubborn about that one. Haemonetics is a blood transfusion company that might be worth a closer look, either for core or as a more of a trading non-core opportunity. But you can see just some of the characteristics across the board, and you can see that Haemonetics actually rings the bell in a number of different positions. What's even more interesting is between 25 and 30, you got these guys. And
I'd say too, Mark, Shake Shack at the end of your list. I did ticker talk on the earnings per share, or the idea of shares issued by travel and leisure companies. And Shake Shack is interesting that they are, if you grouped it as, if you made up an industry called fast food, they're the laggard of fast food because they don't have drive-through, frankly. But I mean, they do some delivery, but then even when they're delivering, they were in city centers and where events were. You know, they were part of going out to the theater, to a show, or to the office.
Mm-hmm.
So they were in the wrong place, and they had kind of the wrong mix. I think there's a real opportunity for them, or let's say a test for them to see if they adapt their business model to not go through that ever again. So I don't know what they're doing. I haven't read. I'm not sure even when they're reporting if they've had a chance to comment on it. But that could become an interesting turnaround if they build on the strengths of their category as opposed to just being, you know, the best burger you could find in a fast time frame.
Yeah, and I think it could be an interesting example of this notion of chasm. They're in a chasm. They got caught, as you were just describing. And this image or vision of what does the other side of the chasm potentially look like and when, and that's basically what you would be looking to the company's management to try to paint that picture for you. And it could be an opportunity, but right now they're really snagged by the structure of their business. And I mean, they have good stuff. They've got a good menu and some pretty loyal customers, but they're clearly struggling. All right. So with that, here's your reminder that if you go to YouTube, search on Manifest Investing, we would love for you to subscribe so that we can make you aware of any time we post updates. And the updates include any archived recordings from both sessions or roundtables. But what I'm showing you here is the 3 successful investing sessions that we've had, starting with last May, continuing in November, and then last week. All 5 of the sessions are available there, so you can take a look at them, and you're certainly invited to take a closer look. We did cover that projected return on value fairly extensively. Ken and I did in the middle session on your page back around Christmas time last year, and we're always continually encouraging people to discover not just small companies, but excellent companies all around. And so with that, I mentioned it, and Matt actually set the table for it, this notion of across the chasm. You can actually look back to about a year ago when Ken and I made this presentation where we talked about we seem to be heading into an incredible economic disruption, generating outliers left and right. And we used the image on the upper left as the cover slide. And I believe that's from Norway, and it's obviously a challenging piece of road with some question as to what's on the other side. And the last slide in the presentation that evening is what's on the other side. Pretty spectacular vista on the other side once you get across the chasm and into the visibility of what the future may hold. So again, just a reminder that our stock analysis methodology actually achieves that if you allow it to, and if you immerse yourself in it and pay attention to some of those key factors we talked about with McDonald's. So with that, I'm going to go ahead and shut down the recording. Stick around for questions if anybody's got stuff that they want to kick around. But thanks for coming out, and we'll be back next week. And we will be back next week in the afternoon and in the evening for the May roundtable. So thanks, everybody. Thank you, Matt. Thank you, Len.
Thanks, Mark. Thanks for holding on the fort.